I mean, certainly the first thing they'll do is stop lending, right?
Correct.
Just keep on taking deposits and trying to build up their balance sheet. But they may have to start calling in loans, right? And oftentimes it's the healthiest loans that get called in, right? The ones that are most likely to be able to be paid back, right? So you may be doing everything right with your property and suddenly find the bank is calling your loan because their hands are kind of tied.
One of the things I think we need to talk about is commercial banks. We're operating in a world where I think a lot of commercial banks are under stress. We have a list of, or we have a number of 293 banks identified by the Fed, most of those with balance sheets of 10 billion and less, aka small institutions. But with commercial banks making up somewhere around 80% of lending historically in commercial real estate, very localized, one, two, three, four branch institutions. We need commercial banks. And right now they are struggling. And if rates stay where they are longer, there could be more pain there. So I thought we'd talk with Jonathan Twombly about commercial banks, how important they are, how does this get cleaned up? And let's go from there. Hi, Jonathan.
Hey, Michael, how are you?
I'm doing well. So just remind folks from your experience being in the commercial space, just how important is a regional bank to most operators?
Yeah, well, I mean, most people who are buying multifamily are, or pretty much any commercial property, are going to be dealing with local banks, right?
Correct.
I mean, actually, any kind of commercial property other than, uh, you know, large multifamily, branded hotels, and downtown core office properties, are going to be dealing with regional banks, right? And um, so any multifamily property that's got a loan of less than $1 million is going to be a local bank, right? And most other, strip centers, local offices, local hotels, non-branded hotels, like pretty much anything you can think of, medical office buildings, like whatever it is, you're dealing with your local banks for these kinds of properties. So it's a huge piece of the lending, pie that's represented by these smaller institutions.
Yeah. And again, a lot of them were very active, during, the pandemic. They were doing lots of loans, lots of refis. A lot of the debt has terms, right? You think the average term on a commercial loan's 5 years, you think?
Yeah, for local banks, typically your 5 years is your max.
Right.
And I mean, the one thing I would say that with the local banks that maybe is going to help is that for local banks, they tend to give shorter amortization periods. So they're collecting more of their principal back sooner.
Right.
So that may mean that for people who have, if you bought a property on a 20-year 5-year note with 20-year amortization, you've paid down a
Yeah.
lot more of your debt than you would at 30-year
Yeah.
amortization.
Good point.
So
Yeah.
so you that on the margins could potentially help some people refinance, right? If they've
Yeah.
paid down more of that principal.
Yeah. The other thing about regional banks that I think a lot of folks are missing is, if you're in trouble, right? You're on that list of 292, or you get on the next list of 350 or whatever it becomes, a lot of your decisions are really taken out of your hands, right? Because then you have oversight and other functions, and they may not have a choice but to,
Yeah.
quote unquote, call loans or whatnot, right? It's yeah. Again, they may not have a choice.
Yeah, well, I mean, if they're exactly the bank regulators come in and they say, you're upside down by on your balance sheet, then they may have to start calling loans. I mean, certainly the first thing they'll do is stop lending, right?
Correct.
Just keep on taking deposits and trying to build up their balance sheet. But they may have to start calling in loans, right? And oftentimes it's the healthiest loans that get called in, right? The ones that are most likely to be able to be paid back, right? So you may be doing everything right with your property and suddenly find the bank is calling your loan because their hands are kind of tied, right? They've got to
Yeah.
get that pull back. And so, yeah, it's bad. They don't get the same, kind of leverage as the big banks, right?
Yeah.
So
They're not the big six or whatever they are. They don't, the rules are a lot more fixed and structured for commercial banks. The other thing I think about commercial banks is not only will they stop lending, but to your point, um, if they have to call loans, I think you're right. They're going to call the strong, like the ones that are most likely
Yeah,
to
to
be
be,
paid back.
yeah,
Yeah, to
yeah.
be made good. So I think these are just things to watch out for. Um, and again, I another thing that I've seen is transactions are really down. I'm curious, is that are we so early in the process that's more about the seller having wish pricing than say lenders being out of the market? Do you any thoughts on that?
It's probably both,
Probably
but
both. Yeah.
I think there's a lot of, yeah, I mean, lenders definitely are not, they're retrenching, right? It's just harder to get stuff through committee right now. They're really looking for those loans that are just a can't miss
Yeah.
opportunities. And, but at the same time, transaction volume is down because sellers have, like you said, the wish pricing and to the extent you can get a loan, the lenders are looking at these and going, nah,
Yeah.
so um, that's, those things always sort of go hand in hand, right?
Yeah. So I'm just curious if regional banks, let's say they shut off for 6 or 9 months as they heal their balance sheets or deposits, where where does the average person go? Do big banks even want to play in these loans, or do we got to go seller financing, or what happens if commercial banks just say, no, no mas, I'm not playing for a little while?
Yeah, I mean, well, there are still bridge lenders out there, right? There's hard
Mm,
money,
okay.
very expensive, but you know, it could work. A bridge loan is called a bridge loan for a reason. It's supposed to be temporary, right? So maybe if you're saying like, hey, I think I just need a year and I'll pay these eye-watering interest rates for a year just to get me to the over the hump.
Mm,
There's going to be some of that.
okay.
Cash in refis, or there's I'm sorry, when you were talking about buyers, not refinancing, but there's seller financing obviously is going to be a part of this too, but that's only going to work where the seller is really got no debt on the property, right?
Yeah, they have, yeah, yeah,
It's hard for them to, I mean, they really can't probably reach their loan covenants to like sell the property without repaying back the loan and then just like make the payments, so
hmm
maybe there'll be debt assumptions. I think debt assumptions are going to be a big
mm,
piece of this, but a lot of the time with the debt assumption, you're talking about 50% LTV, right? And it gets very
right.
hard to make the numbers work there. It can be a good play. Like if you have a long view of things, let's just say you're an individual buyer as opposed to a
Yep.
syndicator who needs to produce a return to investors. Like if you're an individual buyer and you have cash, then it may make perfect sense for you to go in at 50% LTV now, get a good deal, and
Right.
then refinance in 2, 3 years when the lending environment hopefully is better,
Right.
right? So in the long run, I always look at real estate, and as a syndicator, you don't have this luxury, but I was thinking in more theoretical terms, like yeah, people get very concerned about like if your money's not working for you or whatever, or
hmm
the return is too low. I mean, you can kind of like make yourself crazy about these things. What I like to think about is like in 10 years, am I going to be happy I bought this property or
Right.
not?
Yeah,
Right.
me too.
And
Yeah.
it's like, well, yeah, so well, maybe like you can't like the opportunity cost of like maybe having put your money into T-bills for part of the time, and then like later on you deployed the capital and like, oh yeah, maybe you made 10% more over the time period because that like, when you go to sell that property that you bought like 10 or 20 years from now and you put, $3, $4 million in your pocket, are you like really gonna worry that much about the fact that like early on maybe you should have like put the money into something else for it's a silly way to be thinking. Like you should just be
hmm
thinking, is this a good property? Is it going to protect my wealth? Is it going to
hmm
grow my wealth? And that's kind of really all like, am I going to be happy 10 years from now that I owned it? And if the
Yeah.
answer is yes, then obviously don't overpay for it. But like if you have an opportunity, maybe the leverage isn't as good or whatever, or you have to pay cash or
Yeah.
like think about it in terms of like, do I want to own this 10 years from now or not?
It's funny you brought up cash because Grant Cardone called his shot like 9 months ago. He said he's gonna in this environment he's gonna be buying stuff for cash. According to the I guess his Instagram, he just bought a big old apartment building in Miami for cash.
Yeah, I heard about that. Yeah.
Yeah. So it's a congrats on calling a shot. And B, what do you think about just buying stuff for cash in today's lending environments?
Listen, I mean, so first of all, you always have to think about investing on a risk-adjusted basis, not just like a return basis, right?
Sure.
Buying something for cash is the safest thing you can do, right?
No question.
Like there is no safer way to buy real estate than to buy it for cash. And yeah, sure, like your returns will not be as good, but
But there'll
your
be returns.
you'll get returns, right? And
Yeah.
your chances of getting foreclosed on are zero, right?
Yeah,
So,
exactly.
um, and then when later on you can always refinance. But I think that buying for cash can make a lot of sense. And if you have cash, I mean that's the time when you have the ability to get bargains, right? Because there will
Yeah.
be in a market like right now, and
Yeah.
to be able to say I've got the cash, I can buy. We don't have to deal with seller financing, we don't have to deal with anything. Just here's the check,
Right.
right? That is a great position to be in.
I
So,
agree.
yeah, if we'll see how it works out, but I'm sure that it's unlikely he's going to regret having done it, right? When 5 years
Oh,
from now,
he's got the ultimate flexibility. I
yeah,
mean, time is on his side. And I do think it's a genius move because again, you can use cash to also lock in value, right?
yeah,
You're probably going to get a discount
yep,
because you don't have the lending and all of that other stuff, all those other headaches. So I think you can win on both sides, and you just wait for the economy to do what's going to do. It'll be better sometime.
yeah,
So
yeah. I mean, and that's something I think you can generally make a bet on, right? Is will the economy be, let's you can't guess as to whether there'll be a recession, but will the economy be larger in 10 years than it is today, right? And you can pretty
pretty good
much
bet.
guarantee that it will be. So if the economy is larger, will property be worth more in 10 years than it is today? Even if there's a recession, the answer is probably yes, right? So it's definitely worthwhile buying property if you have the runway to just wait, right?
Yeah, couldn't agree more. Couldn't agree more. It's gonna be a lot of fun, folks. Commercial banks are important. Again, I think this is something a lot of investors miss, especially if you're in the commercial space. If you want to have discussions about this with somebody really doing it, you need to follow Jonathan on LinkedIn. Jonathan, it's just really simple, right? Jonathan Twomley?
That's right.
There
I'm
you go.
probably the only one. So,
Probably. All right, buddy. Take care.
yep.